Good morning and welcome to In the Room, our second In the Room of 2022. Today I'm joined by Rademeyer Vermaak. Rademeyer is Head of Portfolio Management at the STANLIB Index Investments team. Welcome, Rademeyer.
Thank you, Stephen. Thank you for having me.
Good day. Yeah, and today we're actually in the Innate Cape Town offices for the first time for In the Room. And the reason being is because I think the STANLIB Cape Town office has actually been renovated, getting ready to go back into the office. So it's nice to be at home for a change. Just quickly before we get going, just a couple of normal house rules. So the webinar will be one hour long, as always. Finish 10:30 on the dot. Rademeyer and I will chat for about 25 minutes about multi-style investing and how it can enhance one's client's portfolio. We'll then open the floor to questions. The questions, as normal, through the Q&A tab. Arifa will kindly assist me on the questions. So that'll be at about 10 o'clock. And then once the questions are done, we'll get back into the conversation. And then we'll close it, as I said, 10:30. CPD points, we'll have important CPD points. I think today is the last day for this cycle. So if you need one more CPD point, today is quite important to you. So please attend the full webinar. And then you get your CPD point. If you can't, there's a short assessment you need to do, and then you receive your certificate. What else? My name's Steve Backhouse. I often forget to introduce myself. And I think that's all of the house rules and that. So let's get started. First of all, Rademeyer, first question I'll ask is that I believe you represented South Africa at the Soccer World Cup. Is that correct?
That is correct, Stephen, to a certain extent.
Yeah.
So in the year that the World Cup was hosted in Korea, I was doing my final year at varsity, doing an engineering degree, and I actually represented South Africa in a robot soccer World Cup. So they had this parallel robot soccer tournament in parallel with the FIFA tournament.
So whilst the actual tournament soccer, the World Cup was going on,
yes,
there was a robotics one.
There was a robotic soccer. And it's fascinating. The goal of this organization, it's called FIRA, so Federation of International Robot Soccer Associations. Their goal is to, by the year 2050, have a team of humanoid soccer playing robots that will take on that year's FIFA World Champions. So this was in, 2001, 2002, so a couple of years ago. But even back then, there were humanoid robots walking around, kicking a ball. And our team, we had these little boxes playing on a table tennis table, boxes with wheels, and then pushing around a table tennis ball. Fascinating. So a lot of data to process. You've got a camera on top recording everything that's happening, the position of the ball and the robots, and you then got to write a strategy to make these robots play. That's how I represented South Africa.
That's quite a feat. Did you actually get to enjoy the actual Soccer World Cup whilst you were there?
Yeah.
So you went to a few games and.
Yes. So quite a vibe and quite an atmosphere at such a World Cup.
And how did you get into that team?
Well, basically, studied electrical and electronic engineering, and they picked a couple of students from across South Africa to put together this South African robot soccer team. Yeah. So
technology is your background, and that's
love it.
Yeah. So that's it. Yeah, and which is obviously what we're going to talk about now. It's a big part of your investment process and how you look at the different stocks. So now again to the actual meat of the discussion. We're speaking about multi-style investing. So first off, very simply put, what is multi-style investing?
So Stephen, I think the best way probably to land the concept of multi-style investing is to shift the landscape or the playing field from the equity market or the stock market to the property market, where I think it's quite intuitive what these styles are. So if you think about, imagine yourself as a property investor, and let's make it a residential property investor. A value property is a property that is kind of in the rundown area of town. The property needs some paint. It's it's a bit run down. But because the rates and taxes is so low, or so low in that area, the rental yield that you can ask relative to the price you paid for the property means that your cash flow is actually positive. So there's some risk. Property isn't pristine, but you're getting a good value property.
Yeah.
On the opposite side of town is where the quality properties are. It's very expensive. New
Camps Bay.
kitchens, let's say Camps Bay, for example.
Yeah.
New kitchen, new bathroom, top quality finishes. Rates and taxes bill is high. There aren't many people that can afford that, so you can't really charge that premium on your rental. So there's less risk in the actual property, but you pay up for that, and so you pay up for that quality. So that's the quality style in the sort of property mindset. And then growth, which is the third dimension we look at. So we look at quality, value, and growth. If you think about growth, think about a property where the municipality has already approved plans for you to add a granny flat where you can put a student in, and you can enhance your cash flow using that. So there's the potential for you to grow your revenue stream. So that's a growth property. Now, typically in every town and every city, there's a property magnate that owns properties, and some property magnates prefer to buy those high value, low cost properties and generate that cash flow. Some property magnates prefer to buy just the quality properties, and they don't want the risk that goes along with value investing. And some buy growth and developers. And I think in the fund market, you typically find that fund managers typically invest along one of those styles. So that you find a value manager or a quality manager or a growth manager. But just finishing off on the property example, it's highly unlikely for you to find a property that ticks all the boxes. So that's very cheap, top quality finishes in the best part of town, and approved plans to develop the property. So what you would do as a property investor to give yourself exposure to all these different styles of property investment is you would buy some value properties, some quality, and some growth. Now, I think about this as a sort of a triangle with quality, value, and growth that's on a ball.
Yeah.
And like an acrobat, as a fund manager or as a property investor, you try to manage this to try and keep all three angles in the air. Because the reality is that as soon as you go to value and value touches the ground, quality is in the air. So there's never an opportunity with a single investment to make sure that you're balanced. But if you build a portfolio, that's when you can build a portfolio that is balanced across these styles. Now, why that's important is because these styles of investment perform through different phases of the macroeconomic cycle. Typically, in a panic, like in 2008 or with the COVID crisis, there's a flight to quality.
Yeah.
And that is when everybody wants to be in the best quality stocks and the best quality properties. When the Fed opens the floodgates and there's a lot of liquidity flushing into the market and risk is easy to take, everybody wants to buy the cheap properties because that's where you can get the cash flow yield. So with a blended portfolio, you're always exposed to one of the pistons that's firing. You're always exposed and you're managing your macroeconomic risk. So if I can take the property example back to the stock market.
Yeah, because I was wanting to just make sure, to be clear, I'm not actually talking about a property portfolio. The multi-style fund is actually a equity fund.
Yes,
you're just using this property as an analogy to explain it.
To land the concept of style investing. It's the STANLIB Enhanced Multi-Style Fund, which is the fund we're talking about, is a general equity fund. And if I take the example out of property, which I use just to land the concept, to the stock market, the same concepts apply when you want to try and pick stocks and when you want to build a portfolio. We look at slightly different metrics, but the same concept applies. So in the growth dimension, when we talk about growth, we're talking about the top line of a company. So the sales.
Yes.
What is the opportunity set for this company and what is the opportunity to grow that? When we talk about the quality of a company, we talk about the ability of a company to translate the top line to the bottom line. So how profitable is the company? What is the return on invested capital, the return on equity, the ability for management to ensure that whatever they sell comes through as profits? That's quality in the stock market. And then when we talk about value in the stock market, we look at the multiples that you pay the classic price earnings ratio, but there are a number of different ways to build a holistic perspective on a company from a value perspective. And that's what we do, is we take these characteristics of every company and we ensure that we balance it on the ball, so you are balanced in every macroeconomic environment.
So what is your view that, I mean, for example, that actually our kind of stock market isn't big enough to have kind of a value play or a growth play? Yeah.
So I think the reality is that the number of stocks listed on the JSE has come down.
Yeah.
But it is still one of the top emerging market destinations for foreign capital. We've got a deep equity market, and we've got enough stocks for us to be able to build, and for any fund manager to build, a well-diversified portfolio that gives you exposure to the return drivers in the South African market. So I would say our market is more than deep enough.
Yeah. Okay. No, good. So one thing also I listened to a webinar you did, I think it was about 2 weeks ago, and you spoke about systematic investing. So now, can you maybe also just delve into that a bit? What is systematic investing?
So traditional fundamental active management composes of two sections, two dimensions. The one is looking at the financial statements of the company and ascertaining that growth potential in the sales, the profitability, and the valuation of the company. And then there is the application of a discretionary overlay. What we do is we look at exactly the same information from the financial statements, but we don't do a discretionary overlay. We implement the optimal investment process in a rules-based and a systematic way. So we keep the process consistent, because we believe that a discretionary overlay is a double-edged sword. There are times during which you can add value, and there are times when you detract value.
And so when you talk about discretion, you mean like you must take almost a view,
qualitative,
versus
an interview with company management would give you a feel for what you think. It's based on feeling and
emotion, potentially.
And emotion, yes.
So again, you meet a charismatic CEO, you're probably going to feel better about the company than if you met someone who's maybe a bit kind of less charismatic.
Yeah, 100%. So the reason why we do that is we take the emotion out of the investment process. We also think the emotion as a fund manager is an important potential driver that can also be value additive or value destructive.
Okay.
And by taking the emotion out, we ensure that we deliver to our clients a consistent, persistent investment process. And we are able to, because we let the machine and the technology do the hard work, we are able to do that at a significantly, or at a very competitive cost. So that is one of our key selling points, is because we built this balanced portfolio that is balanced on the ball. Okay, the portfolio that we provide is better than the benchmark, which is the capped Swix in this example, in the quality, value, and growth dimension. So it generates alpha because it's diversified, but we're able to do that at a lower cost as well.
So how do you, okay, question, that's the cost, because I know your portfolio is very well priced compared to the market, but how exactly are you able, so do you feel that from your perspective, that actually your costs for running the portfolio are actually that much less than some of your competitors?
100%. So to give you some numbers, in terms of, if you look at the 5-year numbers in the Morningstar general equity category, the STANLIB Enhanced Multi-Style Fund is in the top 20% in terms of performance. So it generated significant alpha, and we understand why it generates alpha, but it's also in the bottom 10% in terms of net expense ratio. So it's one of the lowest cost funds, one of the cheapest funds you can find in the SA market.
It doesn't include passive funds.
The funds cheaper than multi-style are all basically pure passive funds. So in this proposition, you're getting a very active portfolio that is very different to the benchmark, that gives you exposure to these different styles at the same time. So you don't have to pick when to buy value, when to buy growth, and when to buy quality at a very competitive cost.
Yeah.
And I think the other important point is that because the process is emotionless, we've never made an emotional investment decision. The return stream is a diversifier to your traditional fundamental active managers. Okay. So you get a systematic, high conviction active portfolio.
Okay. So another question, there's a lot of talk about almost alternative investment strategy at the moment. So obviously, I think you go back kind of 4 or 5 years, there was most of the kind of the industry inflows went into kind of your multi-asset type portfolios. Then now they kind of, with the DFMs coming along, a lot of the guys kind of, they go back to there's a more building block approach. But there's also this talk of kind of adding a bit of extra alpha with an alternative investment strategy. Would you say this fund is one of those?
Most definitely not. This is a classic active equity stock picking portfolio. It is designed to go toe to toe with any other active equity fund manager.
Yeah.
It is certainly not passive. It is certainly not alternative. It is a bottom up stock picking portfolio that makes use of the best available tools from data science and technology to ensure we manage the risk and we pick the best stocks when we construct our portfolio.
Yeah, as you said, and the key thing there is, I mean, I've seen you've got a very cool model that you guys use, which also really helps you kind of drive those results. Am I right saying, and you built that model yourself? All right.
Yes, that's right.
Team.
Yeah. So we are able to look at the fundamentals of every stock and form a holistic view on its quality drivers, its growth drivers, and its valuation drivers to give us a view for the alpha signal. So whether we like the stock or not from an alpha perspective.
Yes.
But because we are able to measure the risks in the portfolio from a data science perspective, we can manage the risks. So we bring together the alpha side along with the risk side in a very optimally constructed way to blend it into a portfolio that gives you the best possible exposure. It really is, in my mind, the basics of active investing, but better than the benchmark in positioning.
Okay. So let's get into some practicalities then, because again, a lot of this is kind of theory-based at the moment, but again, the reality is people like myself and the guys on the street is actually about understanding it from a practical point of view. So if you can give us some examples of maybe, you spoke about alpha signals, but maybe also give me an example of kind of where you've taken that risk view. You go, hang on, I don't like that guy for this reason.
So Stephen, I think you talked earlier about this this portfolio as a stock view. How do you view a portfolio as if it was a stock? So if you look at a stock, it's got a single stock has got quality, growth, and valuation dimensions. But you can use that same lens to look at a portfolio that consists of a number of stocks put together. That portfolio as a little packet will have a return on equity, a price earnings ratio, and analyst revisions and earnings growth over the last 5 years as a number. And the way to calculate that really is this nifty little Excel formula called sum product. You take the weights in your portfolio with the return on equity for every stock.
I can see our audience going to Google the sum product to see if they can do it themselves.
It's really quite simple. If you got the return on equity for every stock in your portfolio and you've got the weight, you can calculate the portfolio's exposure to that dimension. And that is in essence what we do is we optimally adjust the weights away from the benchmark and far away from the benchmark to give us a portfolio that's got better quality characteristics, better value, and better growth. The bottom line is, though, that at the start of the day and at the end of the day, we pick stocks.
Yes.
So we look at the fundamentals of a stock such as Investec Bank.
Yeah.
And we look at its quality. We build a holistic quality evaluation signal view. We build a holistic growth and valuation view for the stock. And then we measure the risks of every one of our stocks in terms of how it combines with other stocks in the market, as well as its macroeconomic risks when we construct our portfolio.
Okay. So just on that, I mean, again, so actually, carry on with your Investec example.
So I think Investec is one of our top picks, and we've got the most constructive view on Investec. And that really comes down, if you think about what's been happening in the news, Investec's been exposed to this inflationary cycle that we're in at the moment, and central banks hiking interest rates. And I think the concerns and the read-through on that is just on the credit worthiness of the SA consumer and the impact of rate hikes and the rand on the SA consumer. We also see that Investec has got a very strong balance sheet. So it's able to capitalize on these opportunities. And if you look at our scoring for Investec, you'll see that it's gotten a little bit more expensive. So our value score has come down,
Yes.
but our growth prospects has picked up.
Okay.
So we are still very bullish on Investec, and we've actually increased our active position slightly over the last couple of months in Investec.
So again, so you just to understand that. So basically, what you're saying is that so you bottom up, okay?
Yep.
So again, you like Investec, but one of the reasons you like Investec is because of the macro environment, essentially, and the way and obviously their balance sheet and some, yeah.
So I wouldn't say that we like it because of the macro environment. The macro environment feeds through
Yes.
into the information that we analyze,
Okay.
and that helps us form our view.
Yes.
So I think that touches on an important dimension in the portfolio construction, which is this top-down macroeconomic impact, because everything is driven by the war in the Ukraine, by inflation, by the Federal Reserve, basically the liquidity that they're injecting and that they're now extracting out of the market. Yeah. And the way we manage that risk is we know that every stock is driven by its fundamentals,
yes,
its quality, growth, and value, but also by macroeconomic drivers that feed through on the stock. And what we do in the portfolio is we maximize our fundamental insights and we manage the macroeconomic risks. So to make that perhaps a bit more practical is for Investec and for every stock in the SA market, we are able to measure its exposure to interest rates, to the rand-dollar exchange rate, to the gold price, to the oil price. And then when we construct our portfolio, we ensure that we've got the same macroeconomic exposure as our benchmark to these macro drivers. So if the gold price rallies and gold stocks in the benchmark rally, we want to have the same gold exposure so that we rally the same amount due to the macroeconomic driver as the benchmark. And then our fundamentals should add value and add alpha on top of that. Okay. Does that?
Yeah, absolutely, it does. Basically saying is because the benchmark will rally because of the macro, but you've chosen stocks and fundamentals to actually outperform the benchmark.
Exactly. Yeah. 100%.
Okay. Yeah.
So we're managing the risks.
Yes. So I want to get into the risks because that's often. So we spoke about earlier. We spoke about how we actually got it wrong with Naspers a few years ago. And again, it's one of the, you said to me earlier, you said actually one of your great learnings is because from a fundamental perspective, you were right.
Yeah.
But the macro risks actually, because you're underweight Naspers, you actually missed the run.
Yeah, so I think Naspers, we've been underweight Naspers and we've had a bearish view on Naspers for the longest time.
Yeah.
I think lately, given the Russian exposure of Naspers, the Chinese tech exposure of Naspers, it's been one of the key drivers in terms of the fact that we've been underweight or Naspers in the portfolio. But we've been underweight for a very long time. And it's one of the biggest learnings I think that we've had in the portfolio. And I think the important point to make here is that we are always improving our process. So it's an emotionless process, but we're constantly doing research, scouring academic papers, staying at the forefront of risk management techniques to ensure that we deliver the best possible portfolio to our clients. And one of these improvements that we made is because we've been underweight Naspers, and Naspers is driven by its fundamentals, bottom up, but also significantly by macro. And the rand, Naspers as a rand hedge had been performing and added a lot of volatility to our portfolio. So the way we manage that risk is to bring in this macroeconomic exposure evaluation. So we started to say, we don't like Naspers as a stock, but it's adding volatility to our portfolio. How do we manage that portfolio whilst maintaining our bearish view on Naspers? So we measure the rand-dollar exchange rate exposure of Naspers. So as the rand moves, Naspers moves, and it's got an impact on our portfolio. But if we can find another stock where we like the fundamentals that's got the opposite rand-dollar, we can maintain our Naspers underweight, go overweight the other stock, and neutralize the rand-dollar impact on the portfolio of Naspers. And that is the way that we look at the portfolio.
Because you don't want to be holding a stock that you don't like.
Exactly.
Yeah.
Just because it's a rand hedge or because it introduces volatility.
Yeah.
So because we are able to measure risks so well, we can manage the risks when we construct the portfolio.
So we're going to get to some questions just now. Just a reminder to everyone to put the questions on the Q&A. We've got some coming through, which is quite nice. Which again, yeah, we'll get to just now. I think let's use one more example. I think we spoke about Exxaro earlier beforehand. And Exxaro is obviously one of the stocks that you do like. So why do you like Exxaro from a fundamentals point of view?
Yeah, 100%. So I think in March, Exxaro put out a really positive trading statement. And it has certainly been affected by the volatility in the commodity markets as the war in Ukraine unfolded and as the Fed started to pull back on the liquidity and started to do quantitative tapering as opposed to quantitative easing. But we do still see those fundamental drivers in terms of the quality of Exxaro as a stock and its growth.
Yeah.
So even though it's becoming a little bit more expensive on a valuation perspective, the sum of these holistic parts tells us, and our view on Exxaro is that it's one of our top overweights. And we've been starting to build our overweight in Exxaro over the last couple of months, from about 3.5% to about 4.2% overweight in Exxaro.
Now, Ryan's saying is actually you don't just go and say, okay, we like Exxaro, we go all in. You take a 12-month view.
Yeah, that's 100%.
Yeah.
So we think that's an important mitigator of risk as well. Is as soon as you start to form a positive view on a company, it's important to always put your risk manager hat on as well. What if I get this wrong? So.
Sorry.
I
think we're having a fire alarm, eh? That's the beauty of doing these things live is yeah. So
well, I guess there's not much we can do about that.
So maybe no, it's not much. So Arifa, if you can just tell us what the noise is like on the other end there, so we can carry on. Okay, we're going to try and carry on. Yeah, if it's unbearable, then please let us know. There's not much we can do about
unfortunately.
it. Yeah.
It's not bad. Okay.
Okay,
so
cool.
The mic's on picking it up.
Okay,
cool.
That's good. Okay, we'll carry on.
Where was I?
Yeah.
Talking about.
Sorry. Okay. Well, no,
about Exxaro and the stepping into the position.
Yes.
Yeah. So we think that stepping into your conviction, as you build your conviction in a stock and you build your view, is a more optimal way to keep transaction costs low and ensure that you, in the correct and systematic way, translate your view into the portfolio.
Okay, cool. So I think it's probably a good time to get to questions. So just for everyone on the audience, is that I'm glad you can't hear the fire alarm too bad. It's quite loud for us, but we're already going to try and push through. So sorry if we do seem a little bit distracted. So first question we get to is from Brandon Naidu. Can we get a view on active ETFs? Why is the JSE looking at allowing this? What benefit does it bring?
Yeah, that's a very interesting and very good question. So I think that the beauty of ETFs as an asset class is the fact that you can trade it at any point in the day. And it gives the allocator a very easy way to access and change their building blocks in their portfolio. So active ETFs, it takes the classic passive ETF or index tracking ETF to the next level, where an active manager, his holdings is actually implemented in an ETF wrapper on the exchange. So,
as you say, the key thing is that you can make a call right now and trade it, as long as the stock market's open.
And you only need to have one account. You only need to have an account with the JSE or stockbroking account in order to be able to trade any of these ETFs. The holdings are completely transparent.
Yes.
And you can trade it at any point during which the market is open.
Yes.
So I think
instead of waiting for the daily price at the end of the day,
instead of waiting for the daily close, and you've got full transparency. I think it's a positive development for the market.
And the timing of this, do you know?
I think the JSE is still in the consultative process, but they starting to roll these out. We're certainly looking at it as well.
Okay.
Yeah,
Is it in international market? Is it quite commonplace?
it is. Yeah,
okay.
there are a number of these active ETFs available.
Okay,
Yeah.
cool. Okay, cool. Next question from Anonymous. What do you mean by investing in constituents of an index? How does this work?
Sorry, can you repeat the question?
Yes, I'm also not sure. What do you mean by investing in constituents of an index, and how does this work?
So I think we start off with, and if I interpret the question correctly, we start off with the benchmark, which is the index, and then we go significantly over or underweight the stocks. Overweight the stocks we like and underweight the stocks we don't like. And we use those quality, value, and growth dimensions as our fundamental stock picking tool. And then we use risk management from a top-down perspective to build the portfolio. So I think there will be some overlap in terms of constituents, but the fund is very active. If you look at the top 10 holdings of the STANLIB Enhanced Multi-Style Fund versus the Capped Swix benchmark, I think there are only 2 stocks that are overlapping between the two. So it's a vastly different portfolio than the benchmark.
Yes.
But it's got better characteristics.
How many holdings have you got in the portfolio?
It varies on a monthly basis. We reevaluate and implement our views on a monthly basis. And it varies between about 34 to 37 stocks through time.
Okay. Cool. Okay, so the next one, which I think I quite like this question. How do we achieve diversification in this portfolio?
Yeah, that's an excellent question. Yeah. So classic finance 101 is by exploiting the benefits of correlation. You can maximize your alpha and minimize your risk. And that is exactly what we do. Because we can measure our risks so well, we can optimally extract that correlation benefit. So when we build the portfolio, we know that we like or dislike a stock based on its quality, value, and growth fundamentals. Yeah. We know how well it correlates with other stocks in the same sector and in the rest of the market. And we can blend that together to build a portfolio that is optimally positioned, that has got the risk reduced, and that has got the potential for outperformance because it's blended. It's got all 3 triangles in the air.
Yeah. So key also for you is that your diversification is in the equity block, if you like, not in the overall asset allocation block. Yes. I think that's important for the audience.
That is important. Yeah, this is an equity proposition.
This is an equity play. So again, depending on your client's needs, they'll need X amount of equity, and then that you need to build the rest of your portfolio with your classic kind of cash, bonds, property, etc.
But in the equity building blocks, we optimally extract the diversification. Yeah, I think maybe another it's an opportunity to talk about the diversification that this product brings when you blend it with other active managers and with even with passive building blocks. So we've actually done a piece of work on the correlations of the alpha of our product. So maybe some perspective is the fund is over the last 5 years, top 20% performance, bottom 20% fees. And we've generated alpha of about 3% over a 1-year basis and an annualized alpha of 4.3% over 5 years. So that's every year, 4% of alpha. Yeah. So we've then looked at the correlation benefits that this product brings.
So we now I think the fire marshals are arriving, but okay, carry on.
And we analyzed the alpha correlation of our fund with other active managers. And because the process is so different, we find that the alpha correlation is actually negative to 0.
Okay.
So the reason why it's important to look at alpha and not just look at the correlation of the fund performance is because the majority of performance of equity funds is driven by the market.
Yes.
So the market beta.
Yes.
So you need to strip out the market return.
Yes.
And focus on the alpha and then do your correlation analysis on the alpha streams to ascertain whether there's a diversification benefit to be obtained by blending the funds.
Yes.
And because this investment process is so different, there is a significant diversification benefit in blending this with other active funds.
Yeah. Yeah. Okay.
It lowers the cost on your fund fact sheet. It adds alpha and it lowers risk. So it ticks all the boxes.
Yeah. And I suppose that's exactly what, again, it's that correlation is such an important thing, because I remember, again, you go back a number of years and you put 3 balance funds together. Actually, the correlation, I mean, they basically performed exactly the same.
100%.
Because they were just above the benchmark or follow the benchmark.
And I think where this diversification benefit comes in when you blend it with other is that the most South African fund managers invest according to a specific style.
Yes.
Like I said at the beginning, so there will be a value manager, a quality manager, and a growth manager. And these all perform at different points in the cycle. What this fund brings to the market and to the table is a blended, you don't have to know when to buy value, quality, and growth. And that is different.
Yeah.
And that is why the alpha correlation is value accretive.
Okay. So a couple more questions from Anonymous. Is multi-style an example of quantamental investing? I haven't heard that one before. Is this the future of active management?
Yeah, so multi-style, we don't have the discretionary overlay.
Yes.
So we do the quantitative systematic investment.
Yes.
I do think that there is and when this person talks about quantamental, it is really where you use this quantitative approach and the systematic approach as the foundation.
Yeah.
And then there is a portion of a human discretionary overlay on top of that.
Okay. Which is the qualitative
which
piece.
is the qualitative piece,
okay.
100%.
Okay.
In my mind, I think there is room for evaluation of that and the value add of that. I think quantamental is certainly an interesting and potentially a way through which to optimally extract the value of human insights on top of a foundation of data extracted insights.
So on that, I mean, maybe it's a similar question. I mean, so again, you big into the data science of things, into the, as you say, the fundamental, systematic. Is there a way of measuring how people make decisions by using data?
100%. And I think it's well documented in a number of books. I think Kahneman wrote the book about the bias that comes out of investment decisions or any decisions made by humans.
Yeah.
And so the data speaks for itself in terms of the biases that humans have. And I think that is what we are trying to control for in this product.
Yeah, because surely if you, for example, I don't know, like, so if you could capture every decision a CEO made, I mean, I know that might sound impossible, but any kind of big announcement or decision that he made, and then put it into a database, and you get surely that would start having some trends and
yeah. So I think that speaks to alternative data sources.
Yeah.
So there are like traditional active management techniques, which is that qualitative overlay.
Yes.
Based on fundamental data.
Yes.
We then take that and we use the traditional fundamental data and we apply data science to it. So we put a more rigorous structure around that.
Yeah.
The next step in that, in the next evolution is to do machine learning.
Okay.
That's on the analysis axis.
Okay.
If you then look at the data axis, you can move beyond traditional fundamental data, the balance sheet, the income statement of the company. You can start to analyze the analyst reports, and you can start to analyze the interviews that that the CEO has with analysts.
Yeah.
You can then also start to look at a more sort of alternative data sources, such as satellite images of Pick and Pay parking lots or ShopRite parking lots, for example.
Yeah.
So in my mind, that is where the world is moving towards. It's embracing the variety and the tremendous exponentially growing number of data sources available and extracting the insights from that and building on human ingenuity and data science to extract insights from machine learning and the non-linear dimensions as well. And in my mind, that's the future, is where all of this comes together to give clients the best possible insights from all dimensions.
Yeah. That's, I mean, it is fascinating and scary at the same time, I think. Okay, some more questions. So they're coming in thick and fast. Thank you. Also from Anonymous, is there a space for style blended income funds, or is it only suitable for equity funds?
So this concept of style investing is certainly consistent on different asset classes. And there's a fantastic book by Antti Ilmanen from AQR on that. We talks about, uses this analogy of looking at every asset class from different perspectives. You can look at it from a style perspective, so quality, value, and growth.
Yeah.
You can look at it from a macro perspective. And in the book, he talks about that old fable of blind men feeling an elephant, and the one feels the leg and he thinks this is a pillar. The other feels the tail, he thinks it's a brush. And they all have got different perspectives on this thing, which is actually an elephant. And in the book, he talks about style investing in the fixed income market, in the commodity market, and how pervasive style investing is, and what a strong driver it is in terms of alpha generation across these different asset classes. So I personally haven't done any research in the income space, but I'm pretty sure that you'll find
and logic,
the same drivers.
I'm sure logic tells me it's
logically, 100%.
Does make sense. Okay, cool. So this is actually a question that's come from quite a few people in the audience. So, which I think you'll quite like. Would you consider expanding your offering offshore? You build the style or fund offshore equity, call it US, Europe, etc. Is this a smart beta style already, or is this smart beta style already existing offshore?
So, Stephen, that is an active area of research for us.
Okay.
So we believe, and we know from our research, we've calibrated our product globally. So we know that these style exposures and this way of investing works in South Africa and in every other country that we've done the research on. So we are in the process of doing the work to potentially, let me not maybe jump the gun, potentially roll out something in the global space.
And question, I mean, like obviously there's the new collaboration with JP Morgan. Is that part of the kind of the work there, or?
It's not. So this is a piece of work that we're doing internally. To see how we broaden this proposition and the thinking around this into the global space.
Okay, cool. Okay, some more from your friend Rowan. What is your view on crypto, particularly Bitcoin? Do you see this trend continuing in the future? Does STANLIB hold an overall view?
Yes, I don't want to go down the crypto rabbit hole right now because I think it goes quite deep.
But it's it's a hell of an important topic. I think also the reason I say that is, I think a lot of people have got a view on it. I think it's a tough one for financial advisors because again, there are such divergent views. At the moment, it's difficult to put your client into a crypto solution unless you actually go and physically buy a Bitcoin or whatever. Yeah.
So I think it's important, if you want to be the asset manager of the future, you must have an informed view on the potential asset classes of the future. So maybe I'll just answer the question in this way, is that I had for a long time believed that Bitcoin is a scam and nonsense and a Ponzi.
Yeah. How long has it been around for now?
For just over
10 years.
11 years, 10 years. Until I did the homework, until I decided, listen, I need to, I can't just say this is a Ponzi or a scam because I've heard it on the street.
Yeah.
I decided to go and do the homework, and my perception of it has changed 180 degrees.
Yeah.
So maybe that's my only advice on crypto for now is don't form an opinion until you've done the homework.
Well, so the reality is that, blockchain, which is what crypto is built on, is a hell of a interesting and advanced piece of technology. And that's very much here to stay.
I believe so.
Yeah.
So the blockchain is in essence a distributed database.
Yeah.
It's expensive to maintain.
Okay.
And if you're going to centralize any of it, it overrides the benefit of it. But it's a decentralized database, which ensures that nobody can override it, which is the important part.
Okay, cool. Okay, moving on for that. Okay, so another question, also from Anonymous. Do you make use of securities lending and or synthetic exposure in order to generate yield pickup?
In this product, we don't. No. So we trade actively, and we don't think the value add at this point in terms of the holding period justifies it.
Okay. Yeah. Cool. So I think we're done for the questions now, but thank you very much. Please keep them coming because we can ask them towards the end. So again, I want to just talk about some of the kind of global themes, macro environment, which we have touched on from a risk perspective. But again, the reason I bring it up is because this is the stuff that clients and advisors are reading every day. How do you, what's your advice, to kind of the financial advisors in terms of how to kind of diffuse that noise, because that's the reality of it. Like headlines grab our attention, they impact our emotions, which then potentially impact our investment decisions. So what's your advice to the advisors in terms of how to help them diffuse that noise with their clients?
So I think what's important is that one stays abreast of the news and what's happening in the macro environment and in the bottom-up stock-specific environment. But a very important principle of investing is for you to develop, and not everyone has the same process, but to develop an investment process that sits with you, that sits well with you, that you believe in, and that you can stick to through the good times and the bad times. And this investment process as a framework is an important foundation for any person to have. Whether you're an IFA, it gives you a framework within which to evaluate the news. Whether you're a fund manager, whether you're a multi-asset manager, having that framework is important.
And to almost filter out the noise.
It filters out the noise and it helps you manage your emotions. It helps you to evaluate any given decision that you've made and justify it to yourself. So process is absolutely critical.
Yeah, I think it's very important. Just making sure there isn't a fire in the building. We're fine. Okay, no good. Okay, no, cool. So I think, so a couple more things. So before we've got 15 minutes left, 14 minutes left. So what has been the biggest challenge in your career from an investment point of view?
So I think, Stephen, that I mentioned that bearish view that we've always had on Naspers. And there was a period where it added significant volatility to the portfolio. And we had to figure out, how do we maintain our bearish view on Naspers, but reduce the macro volatility from a Rand hedge perspective that it brings to the portfolio. And I think that was one of the biggest enhancements we've made to the portfolio in a number of years, is the way to correctly measure the risks of every stock so that you can manage the risks in the portfolio. So it's never easy to take a contrarian position in anything, but I think especially on Naspers. Which is one of the darlings of the SA market. And so it's important to manage the risks well.
And is there anything you worry about in the future?
I worry about what I don't know. So I think if you know what you know,
it's controllable.
It's controllable, but it's about what you don't know. It's about something that we haven't thought about yet, those black swans.
Like a COVID.
Like a COVID, 100%. And what are the risks that can come to your portfolio and to your client's portfolio from that, and how are you going to react? So you have to think about this like a game of chess. If your opponent does that, you need to know what you are going to do. If your opponent does that, you need to know what you're going to do. Otherwise, you're a deer in the headlights. And I think that is what a systematic process brings to the table. I know exactly what will happen to the portfolio if any scenario on this chessboard plays out.
And you almost like, you used to say, again, I think I mentioned earlier, I listened to a webinar last night with Clive Woodward, and one of the things he said, he prepared for failure. So he said, like, it was quite unusual that you'd say to your rugby team guys, at some point in time, we are going to lose. But it's what we do after you lose and we prepare for it is actually how it will make us a great team.
That's a fascinating insight. I think that's That's certainly valuable and valid. And I think I want to make 2 points on that. The first is that this rational portfolio that we try to build, it's not a crystal ball. So we expect the fund to underperform, and it has certainly underperformed during periods when the market is irrational.
Yeah.
So when there's a lot of uncertainty and froth and noise in the market, and the market is irrational, we would expect a rational fund to underperform. But maybe just back to the Clive Woodbury example, I think what's always fascinating to me when I watch the All Blacks play is whenever anybody beats the All Blacks, they celebrate. Like when they score a try, or when the final whistle blows, everybody is like that you celebrating and they're high-fiving, and it's a massive achievement.
Yeah.
The All Blacks never high-five when they win. They expect to win.
Yeah.
And that's a fascinating shift in mindset that takes place. You see they never celebrate a try where they jump on each other and it's a big celebration.
Yes.
The expectation is to win. I think that's quite an interesting perspective.
So another thing that he said was that, so when he actually spoke about when he was actually in his own small business pre being coach of England.
Okay.
Clive Woodward. And he spoke what you normally do is when you win a big deal, okay, you go to the pub and you celebrate.
Yeah.
So it's an overreaction.
Yeah.
When you lose a big deal, you eat it on Monday morning and you bloom and got the board out and you're going, gee, why did we lose it? It's an overreaction. And what he did is he flipped it on the head. If we lost a big deal, we went to the pub and actually things are okay. But he didn't overreact. When we won a big deal, Monday morning in the office, we analyzed why we won it and the things we could do better, which I thought, so again, it's a fascinating webinar.
It's also a way of managing emotions, right?
Yeah.
Because emotions is what drives a lot of decision making and our biases. No, that's fascinating.
Yeah, and again, you realize why you won the World Cup
and became a sir.
Yeah, exactly. Flat out. Yeah. Okay, so we got 9 minutes left. One more question here, Graham Kaplan. What would the recommended investment time frame be for these portfolios? 7 years? Question mark.
Yes, so it is. You should evaluate and look at this in exactly the same framework as any active equity proposition. So on your fact sheet, it's classified in the high category, and the holding period is 5 to 7 years, and this is no different. This portfolio it attempts to give you equity exposure with additional alpha on top. And the alpha is driven by this blended exposure to multiple styles simultaneously.
Yeah.
Of quality, value, and growth. We think the portfolio is back to basics in terms of active investing. And we build a portfolio that is better than the benchmark, but you get the equity risk premium as well.
Yeah.
So that speaks to that 7-year holding period, Stephen.
But again, also talks to, your overall asset allocation and depending on how you've, so if you've got a kind of a youngish client who's able to take more risk, and it's a bigger portion, and can hold it longer, and vice versa.
Yeah, so you'd use this building block depending on your risk tolerance of the medium or high or what's balanced exposure that you build.
Okay, cool. Okay, so I'm going to ask one more question, and it's real kind of a sum up question, and then we'll do the closing. So back to the topic at hand. How does this portfolio enhance a client's overall investment portfolio?
So I think a couple of points to touch on and to think about when you look at this multi-style proposition is, and it's important to look at performance. The fund has generated significant alpha over the last 6 years. And it's important to understand why that has happened, and understanding why it has happened is the reason why we believe it can persist. The reason why the fund has generated alpha is because it provides you with this blended exposure to quality, value, and growth investment styles in one portfolio. So we are able to build a portfolio that is better than the benchmark, with higher quality, cheaper, and better growth prospects than the benchmark. We believe those are return drivers that will persist. And if you can keep all 3 corners in the air, you will generate alpha into the future.
Yeah, and you've proven over time that you've been able to do that.
Certainly, and we believe that's the reason why we believe it can persist. The second important point to make is that the cost is so effective. It is a very cost-effective portfolio. So you're getting a lot of active alpha at a very competitive price. The third point to make on that is the fact that we take the emotions out of the investment decision-making process. So the fund manager emotions, as well as the emotions that you will have to endure to decide when to buy value, quality, or growth. So we take a lot of emotion out of the investment decision-making process. And then if you look at the diversification benefit that this product brings, it is back to basics active investing. It is different than anything else that is in the active space. And if you can measure that by the correlation, and you'll see that it is different and it can add value to your existing set of managers. So it ticks all the boxes. It adds alpha to your portfolio.
Yeah.
It reduces risk and it lowers cost. So in our mind, it's a strong proposition.
Yeah, that's good. Lots of conviction, which it gives the guys peace of mind. Cool. So I think that's it from our side. Just quickly before we end, we have got 5 minutes. So if there are more questions, bomb them through. But otherwise, I'm going to start the closing. So as always, thank you everyone for attending. I mean, your time is very, very valuable. We know that. Very sorry about the interruptions. Hopefully it didn't disturb you guys too much. I think Rademeyer did a great job pretending they weren't there. Rademeyer, thank you for your really insightful conversation. I thought that was fantastic and really interesting. I think if people have got more questions and would like to know more about the portfolio, you can contact your STANLIB Asset Management BDM, and they could definitely get hold of you and chat to you about that. Reminder: the CPD process is, if you attend the whole webinar, you get your CPD point. Otherwise, you'll need to do, if you came in late, you need to do the short assessment. Next webinar is an exciting one. I don't know if you guys remember last year we did a webinar called Elephant in the Room, where we had Kevin Lings and Max de Prier and Abigail from Investec. And we're doing a similar one this year. We're kind of really into really hot, kind of topical, political, economic kind of discussions, good debates. And that's taking place on the 28th of June. So please look out for the invite. There will be a surprise speaker with that as well. And then if you want to know more about Innate, please feel free to get hold of one of your Innate BDMs, myself, or have a look at us, look us up on LinkedIn. Otherwise, that's it. It's a wrap. Rademeyer, thanks again.
Thank you, Stephen.
And
Thank you for having me.
Thanks all. Really appreciate it. Cheers.
Innate is a registered trademark of STANLIB Wealth Management Pty Limited, an authorized financial services provider.